Good morning, class. Professor Pronte here with another video, and we're going to talk today about two main ideas. First, something called bank runs, and then secondly, the economic idea that is related to this is the idea of moral hazard. Moral hazard. Okay. For context, right, where this fits in terms of U.S. economic history, right, we're talking about bank runs that occurred during World War I. So the idea is that with all the uncertainty that was taking place, consumers began to feel uncertain and nervous. They began to feel unsure that their assets would be safe in banks. And so what ended up taking place was that people would rush down to a bank and try to withdraw their money in a hurry. Right? A lot of people simultaneously, all at once, are trying to take out and withdraw their money from a bank. Right? Why do people have this incentive? Well, it's because private banks, right, of course, rely on something called fractional reserves. Right? You guys probably know this. When you deposit your money in a bank, that money doesn't stay there. Right? Instead, the way that banks make profit is by taking all of those deposits, right, keeping just a little bit of them, keeping a percentage or a fraction of them, and then loaning or investing the majority of what's been deposited there, right? So at your bank today, right, at my bank today, right, they most definitely are not keeping anything close to the total amount of money that's been deposited there. So is this a problem? Under normal circumstances, no. Right? Under normal circumstances, if a small percentage of a bank's customers go down and try to take out their money, that's not problematic so long as the majority of customers or the majority of deposits that are at a bank are not being requested for withdrawal. Right? The problem, though, arises when people lose confidence in the banking system and all at once try to remove their money. If that happens, of course, the bank won't have enough money to meet the demands of their customers. All right, so the term for this is called a bank panic or a bank run. And there's a couple of episodes in U.S. economic history where we've seen this. One of them, like we're talking about here, is during World War I. All right. So what then can be done when banks are experiencing these runs like this, these bank panics? Oftentimes, governments will be called upon to rescue banks, so to speak, to make sure that they have enough money to meet the demands of their customers, make sure that those banks don't go under, right? Don't go bankrupt. Okay. When governments do this, though, it leads to this second problem, which is the big punchline here for this video, which is that it can create something called a moral hazard problem. A moral hazard problem. So we don't understand what moral hazard is and how it fits into bank panics. Moral hazard is the idea that when people don't face the consequences of their actions, when people are shielded or protected or saved from choices that they make, it gives them incentive in the future to be riskier, to take on more dangerous activities than they would have otherwise, right? And so the problem is that when a bank is helped out, right? When the government is trying to give stability to the banking system by providing them liquidity, what it actually can do is to encourage risky behavior from banks in the future. There are a lot of examples of moral hazard throughout our economy. Let's see if we can think of some. Right? One area where we see moral hazard is in the existence of insurance markets. Insurance markets are really interesting because there's all sorts of behavioral economic implications. You could take any insurance. Take car insurance, right? Here in California, we're all obligated to have car insurance if if we're going to be driving. And so what that means is that if you or me crash our car, you're shielded in some way from the consequences of those actions, right? Getting in an accident is terrible, right? You might get hurt. You're definitely going to experience a financial loss of some amount. But compare sort of the cost of getting in an accident as is right now when we all have insurance versus the cost of getting in an accident if nobody had insurance, right? If nobody had insurance and you got into a bad car accident, it would be devastating to your financial outlook, right? Cars are super expensive. You can cause lots and lots of damage that you might be liable for. It's likely that a lot of people would go bankrupt if they got in a car accident and car insurance was not available. And so moral hazard then tells us that, yes, it's true, all of us are trying to avoid getting into an accident. But the fact that we have car insurance gives us incentive to drive a little bit riskier, right? To be a little bit less safe than we would be otherwise, right? We're not facing the true costs of our actions, and therefore we're not driving like grandmas out there on the road or something like this. We're not doing everything that we can to avoid the bad outcome. Governments oftentimes have to confront the moral hazard problem as well. Think back to the financial crisis in 2008. Here in 2008, you saw lots and lots of businesses that were quite large and quite significant in the scheme of the macroeconomy on the verge of going bankrupt, right? So automakers, right, car companies, banks, lots of financial companies were facing the prospect of going under. And so the government stepped in then to loan these companies money, to bail them out, so to speak. Doing so with the intention of helping the economy overall, right? Trying to avoid all the costs that would result if those companies went under. What does that do in the future, though? Well, it gives incentive for managers and decision makers of these companies in the future to be riskier, right? To pursue those types of investments that might pay off really well, but might go sideways as well. Right? So we're encouraging risky behavior when governments help out in financial markets. A last example then, guys, of moral hazard occurs with natural disasters. Here in California, so not too long ago, we had a whole bunch of terrible wildfires, right? There were wildfires pretty close to my house. I was scared. We had to evacuate and everything. In the event that folks' houses burn down, the government steps in then and helps in some way, at least, to get people to rebuild, right? And they do this because people have been devastated by a natural disaster like that. The problem, though, right, that we should recognize is that this knowledge that the government will help you out if your house burns down because of a wildfire encourages people to live right at the edge of wildlands, right, where there's a greater danger of a fire than you would see in other places. Right? Without knowledge that the government's going to help you out, you might not live at the edge of a forest. You might take some steps to avoid that risk. And so Californians are not alone in doing this, right? You can apply the same thinking to people who live in areas that are prone to floods or prone to hurricanes or prone to earthquakes or any sort of, there are many examples of natural disasters where we encourage people, or we don't sufficiently discourage people from avoiding those things by putting in place programs to help them out after the fact, right? So all of this is the moral hazard problem with some examples here in recent times, as well as examples that we saw with bank panics around World War I. All right, that's all for this one. See you guys in the next video. Bye.